For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current event headlines, also holiday market fears, misconceptions, and smart planning. Who hates taxes? Raise your hands out there. The best time to plan is right now. And finally, protecting a spouse, the most overlooked risk in retirement planning. My name is Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Randy and Jake Floyd, Floyd Financial Group. Again, we'll start with you, Randy. Good morning. How you doing today?
I'm doing very well, Jeff. How about you?
I'm doing fantastic now that we're together on the radio again. Hey, Jake, how's Saturday morning treating you, my friend?
Doing great, Jeff. Thanks for asking.
Certainly glad to hear that, Jake. I hope our audience is having a great post-holiday weekend. We are smack dab in the middle of the holiday season, and before you know it, it's going to be 2026. My, where has the time gone? Well, let's start off today by talking about today's market trends and what retirees should know. Let's break down the latest economic headlines, rate cut expectations, global bond funds, and what all this means for investors and retirees. So, Randy, let's start with a big headline here. A lot of investors are betting the Fed is going to cut interest rates by a quarter point here in December on about the 10th or so. And markets liked that news at first, but we also saw some turbulence on the first day of December. What's going on there?
The market, in general, we talk about on the show here a lot of times, don't fight the Fed, right? So if the Fed is lowering rates, it's generally good for the economy and good for the market. Of course, if the Fed is raising rates, as we know, that can be pretty ugly too, because we've had that looking back over our shoulder. But been kind of a wild ride, like you said, the last little bit here. Everybody pretty well thought that a rate cut was baked in probably 2 or 3 weeks ago. Then they thought, well, maybe not. It went from like an 80% chance to a 30% chance. And guess what? We're back to probably a 90% chance today. So do we think it's going to happen? I think probably so, but we'll have to wait and see.
Now, I understand that Jay Powell is going to be out of office here pretty soon. Already his successor apparently has been picked. Is that true?
According to Mr. Trump, he already knows who it is. And I think I probably know who it is. I'm not going to say, but I do think that I'm not quite sure even how to say it. I think he will be more accommodating. How about that? Than Mr. Powell has been.
I think he will salute President Trump and kind of do what he wants him to do, which will be really the first time in the history of the Fed that we've seen this, where you have a Fed chair that's basically like, what do you want me to do, Trump? And he's not a one-man band. There's 11 voting members of the committee, and he may find it difficult to get some of those people on his side. But generally speaking, the Fed over the years has just followed whatever the chairman really wanted to do. So if rates are going to come down substantially, you can't help but just want to buy everything in sight. That's just kind of how it works. And I think there's a lot of people that are thinking maybe interest rates are going to go up from here. I don't really see that in the cards. I think if interest rates go up meaningfully from here, it will create a recession, which will be followed by what? Rate cuts.
Right.
I think all roads lead to rate cuts. The question is, do we do it the hard way or the easy way? And so over the next few months here, I think that's going to be a major topic of conversation. I do think that Trump has his pick. He says he has his pick. He has not announced that pick yet. He says he will before the end of the year. There's pretty good consensus around who it is, but I think if that is the case, that should be good for a couple of percent rally on its own.
So it sounds like if Trump does appoint the person that we're thinking of here, is it more likely that we'll have more rate cuts here in 2026 than we would have had under Powell?
I would say that that's 100%, that will be the difference. And, the big thing here is, and what everybody's concerned about is, does it promote inflation as we lower these interest rates? And one of the things we should be reminded of is looking back over our shoulder prior to COVID, we had 0 to 0.25 interest rates at the Fed, and we couldn't get to 2% inflation. So two things. Number one, we printed a bunch of money, sent people home, raised interest rates trying to control inflation. I'm not sure that it is inflationary just to cut interest rates. I think it promotes growth in the economy. I think it can also promote competition in the economy, which will, in fact, help us to maintain and even drive prices lower on some areas.
So, Randy and Jake, let's make this real for investors. If the Fed does cut rates, how could that affect investors and maybe more importantly, retirees?
Yeah, so as rates get cut, money market accounts, CDs, all those things will go down. And people have gotten, I won't say spoiled, but maybe it is a little bit spoiled. For the longest time, money market accounts and CDs just didn't pay anything and people didn't invest that much into them. But when we had the interest rate spike starting in March up to 5.25%, and we could buy 5% CDs, a lot of people love getting that guaranteed interest rate. Well, once it goes back down, and let's say it's even 3%, they're not going to be as happy about taking 3 as they once were at 5. And if it should go lower, they're really not going to be happy. And so they will look for a new home for that money, which is probably going to trickle into the market and into bonds, as well as probably the housing market.
But there is a flip side. Lower rates can also reduce yields on conservative investments, as you said, cash equivalent type of things. So retirees do need a balanced approach that doesn't rely on just one income asset. Talking with Randy and Jake Floyd, Floyd Financial Group. Of course, our phone number, 417-889-7233. If you'd like to get 2026 off on the right start, maybe you should call that number today and sit down with Randy or Jake there, talk about your journey towards confident retirement or growing your wealth. Certainly, we're here to give you a hand. 417-889-7233 is the number. Go ahead and make that call today. Ashley will call you back and find a time that's convenient for you and Randy and Jake here at Floyd Financial Group. No cost, no obligation, and no judgment. Randy and Jake, one story that flew under the radar was the Bank of Japan. They hinted at a possible rate increase, and that caused global bond yields to jump. Why would a move from Japan shake up U.S. investors?
So what's happening around the world at other central banks directly affects the dollar, the strength of the dollar or lack thereof. That in turn has implications on our bond prices and ultimately how much we're spending on debt service and the desirability of our bonds. Generally speaking, Japan's been at zero or near zero interest rates for basically forever, since 1987 probably or so. As we're looking at this, last year, Japan started to kind of lift off of zero for the first time in 35 years, 40 years, and slammed back into the dirt and forced to lower interest rates again. So what's happening in Japan is relevant for that reason. It's also relevant for something called the carry trade. The carry trade is a little bit complex, but I'll do the 30,000-foot view here. The idea behind the carry trade is because the Japanese currency has been devalued for that entire period that I was just talking about, 40 years or so. What's been happening is hedge funds and other traders in the U.S. and around the world have been going in and leveraging the yen against the dollar and then using it to buy tech stocks in the U.S. And what happens is, as that starts to happen, they're able to buy more and more and leverage more and more into these stocks. And so if those stocks start to have a problem, that can unwind really quickly, and they're leveraged into those positions, which means they lose more than they would otherwise. And so it's a very volatile situation, and they're very heavily invested in companies like NVIDIA and Microsoft and Meta and those types of companies. So that's a couple of reasons why we care about what happens in Japan. Those are kind of the two big reasons.
So let's bring it right back here domestically to our shores. And one troubling report that I was looking at the other day showed that wealthier households in this country are saving more, while most Americans are saving less right now. What does that say about the state of the retiree economy?
Yeah, Jeff, before I started my career here as a younger person, I had a career for 20 years in the food business. I worked for a little company that made cheese and things like that, and we sold food to restaurants, and I became district manager with that company for a few years, and then I decided to switch careers. But that company is one that everybody would know. I won't talk about it today, except for the fact that I was brand loyal because I really loved working for that company, and it was good to me for 20 years. And so here I would go to the store, and if we had the side-by-side brand, I'd look at the one that was maybe the great value, and I would look at the one that was made by the company I used to work for. And when it was a little bit more, that's one thing. But all of a sudden, it got to be where it's like 30% more.
Yeah.
And I have been fortunate and blessed enough in this life to where I can afford to buy the higher price stuff. But here's the thing I would say. At some point, you say enough is enough. And I kind of got to that point where I'm like, you know what? There's not hardly a dime's worth of difference in this, and they're wanting to charge me $2 difference, right? Mm-hmm. So I just said, you know what? That's it. I'm done. So I think what we're seeing across the spectrum here, the people that are retired, generally the ones that have really the most spendable or what I would call discretionary income, are starting to take notice of this, and they're saying, you know what, we're just going to stop spending. And so that money piles up in checking accounts, savings accounts, stays in their investment accounts. And so I think that's a lot of what we're seeing here. Consumerism is a real thing. And this idea that, boy, there's the newest shiny thing. And let me tell you, I've been guilty of this. I'm not the pot calling the kettle black, right? I mean, I have been guilty of this, but marketing today is so good and so emotional that it drives especially younger people that are trying to build a family and build a life and get out of the house and experience life. It drives them to maybe overspend, whereas the seasoned person out there that's lived a lot of life is saying, you know what, I'm going to cut back on this. And I think in many ways that's healthy. You know, there's a lot of money that's going to transfer to the next generation. And hopefully they will also learn that the marketers are really, really good at what they do. And sometimes we need to let the emotion of the moment pass rather than just buying something.
Well, Randy, I think the long and short of it is that people are feeling squeezed out there, and sticky inflation means your grocery bill, your insurance premiums, and basic costs are still high. And for retirees on a fixed income, say Social Security, this does reduce their margin for error. Let's look forward, Randy and Jake. What trends are you watching for as we head into the next year, 2026, which is less than 30 days away?
Yeah, so I think the big things is, number one, what's going to happen with interest rates. That's going to be a big dictator as we move forward. Also, of course, what's happening with unemployment by downsizing in general and some forced by AI as it takes over and becomes a bigger and bigger piece. And I think just watching what happens with what we would call this modern day industrial revolution as we move from where we were, just like we did back in the 20s and 30s, where we were all farmers and had to move into factories, and we're having this change with AI at the same time now. And I think those are the things we're going to be watching. How does that play out, and how do these companies do they remain profitable, or are they going to hit a roadblock, or are they going to hit a slowdown somewhere next year when we look at the AI companies?
So for retirees listening right now, Randy and Jake, or near retirees, what do you think is the one thing that they should be doing this week? Or if they're procrastinators, put it off until next week. But the one thing that we should be looking to do here within the next week or two?
New Year's resolutions are those things that generally we're pretty resolute for about 2 days, right?
That's right. I resolved to go to the gym. You go to the gym on January 1st or 2nd, the parking lot is full. You wait until about March. You can park any place you want.
But I would say this, I think a couple things. I think let's look back over our shoulder and let's count our blessings. Let's count maybe some of the errors or the mistakes that we've made. And let's look at what can we do this next year. Really take stock to improve some areas of life that we want to change. Maybe it is losing weight. Maybe it's getting in better shape. Maybe it's starting a savings plan. Maybe it's starting an investment portfolio. Maybe it's just putting money into your 401k. I think that now is a good time to reflect on that. And I would tell you this too. I think one of the most important things that people can do, if you're going to start investing and start saving, automate that process. Make sure that it's not something you have to make a decision every month on a certain day or a certain day of the week. Because I'm telling you, if you have to do that, you won't do it, even though it's probably what's best for you. So I think just take stock of where we are. Look at what you'd like to improve. Some people say, well, man, the elephant is so big. And that's right. And we start with one bite, and that's how we eat the elephant. Remember what Einstein said as well. Compound interest is the eighth wonder of the world.
Good advice, Randy. I hope our listeners enjoyed that. Talking with Randy and Jake here at Floyd Financial Group. Our program, of course, called Show Me the Money. Once again, our telephone number, 417-889-7233. I think that's something that you could do here in the next week or two that would improve your life a little bit, is to call that number, request your Floyd Financial Group Show Me the Money financial review. We'll sit down with you on a casual basis, take a look at what you've got, find out who you are and what your needs, your goals, your wants, your wishes are for retirement, and see if we can design a plan to get there. Again, it's not going to cost cost you a dime, no cost, no obligation, no judgment. We'll meet you where you are. So go ahead, get that done here. Cross it off the list, 417-889-7233. And of course, we invite you to also go out to the website. Check us out online at FloydFinancialGroup.com. Randy and Jake, let's take a break. When we come back here on Show Me the Money, we're going to be talking about holiday market fears, misconceptions, and smart planning when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about the holiday market fears, misconceptions, and smart planning.
All right, Randy, as we head into the holiday season and reflect on the year, a lot of investors are telling us that they're nervous about the markets, taxes, and what surprises that 2026 might bring. So today, I've compiled some of the questions that I'm hearing most often. Randy, let's start off with, what are you nervous about with the market hitting all-time highs?
Yeah, you always have to look at what's underneath and what's really going on in the general economy. And yes, markets are at all-time highs, and that's what they're supposed to do, actually, is over time go up and companies be worth more as they become more efficient, sell more product, and become more profitable. Really, what worries me about people is, especially if they're doing it themselves, is they tend to get kind of in a groove where they think, well, this is just the way it's going to be. And so, granted, there are a few stocks and a few investments out there that you can get into that they just seem like they always go up. But for each of those companies, Jeff, there's probably 100 other ones that didn't. And so I think what's really important is to know that, yes, volatility will return, number one. Number two, we will have all-time highs again. It's what happens in the middle and how you handle that really matters. So I would say they just really need to be cognizant of what's going on. If they would like some help, obviously we're here. That's what we're here to do, is help people design plans for all kinds of financial weather.
And Randy, as I said, I've compiled this list of questions here. One of them that I had, and I know that you mentioned the fact that you had been in the food business for 20 years, and certainly you've been in the financial services business for probably equally as long too. What do you wish you had learned earlier in your career?
That's really... That's really
He's
a great
getting
question.
deep on us today.
But I would say that as I started this career, I really noticed more and more that people didn't really care about how much I knew until we could actually make a connection and know that I understood what's important to them.
Right.
I want to have the best, most efficient system that we can. I want to protect people. I want to help. But also, it just became more and more apparent to me as I grew in this business that really people want to make sure and want to know that we care and we're connected to them, as well as what we're doing with their investments.
And of course, Randy, I think a lot of people know that money is mathematical. Certainly that is a given. But did you learn early on? I mean, how much did you learn that money is really an emotional thing? I think of the woman who said, let's get on with the scary money talk. It really is emotional, isn't it?
Yeah, scary money stuff. I don't know how to even describe it that day, but it would just hit me like a ton of bricks. That's how some people feel about investments, and that it is scary. And granted, anything that we don't really understand can be scary. And make no mistake, markets can act irrationally, but there are some basics that we can help people to understand and, how to navigate all these different situations that come along.
Well, I think she may have been thinking that money is scary because if you don't get it right, it can create a scary circumstance for you. If you don't have money, many people think that that is worse than death. So I kind of understand what she was talking about. But again, money is very emotional, and I'm glad that you find out about people and what their needs and emotions are before you design a financial plan for them. Of course, risk is a big part of that as well, too. What is a misunderstood investment or financial product in your world, and why do you think that is?
Yeah, I'd say there's a couple of them. One is the real estate investment trust, and number two would be annuities for sure. The real estate investment trust sounds all so good on the very front end until you actually own one. It was kind of like back in the day, people say, I went to an Amway meeting and I saw the open, then I signed up and there was a harsh reality.
It's like Mary Kay as well, too. You wanted to get that
Right.
pink Cadillac, I'm telling you.
So the REITs are a little illiquid and promise a whole lot and sometimes a little difficult. Now, there's some good ones out there, no doubt. But the other one I would say is the annuities, the annuity contract and how it works. And there's immediate annuities, there's variable annuities, there's fixed annuities, there's indexed annuities, and really having someone that knows and understands how to use these things and which ones to use. I mean, not all things are created equal. It's kind of like you have to be sure when you go out and you buy a vehicle. If you have a family of 6, you probably don't need a small compact car.
No.
It's,
Or want one. Yeah.
and you don't need a diesel truck either. It just depends on what the needs are for each person. But the annuities in today's world, there's some really good ones that are structured very well out there that can give people some limited downside protection while giving them the lion's share of the upside. And I would just tell people, research it, understand it, ask us questions if it's something that comes up while we're talking to you. And we have people all the time that bring us and say, hey, I want you to look at this annuity statement. Tell me what's wrong with this picture. I've got one of those right now on my desk. While they can be a great tool in some cases they're the absolute worst tool. So it's something that needs to be used when it's appropriate.
Right. There are good ones, there are bad ones, and the right ones for the right situation. Misunderstanding, I think, comes from not matching the product to the person. All annuities are not bad, but they are bad if you do not have the right one for you. Randy, what is a common misconception that people have before talking to you or one of your advisors?
Yeah, I think a lot of it is, well, Randy, I've heard it all before type thing. And that's okay. I mean, yeah, we've all got experience and some that we liked, some we didn't like. But I think that people are generally happy with the fact that before we get into how we're going to invest their money, that we need to understand them and what they're trying to accomplish, right? I mean, it's kind of like if a guy's trying to run a marathon, you don't teach him to swim, right? So it's the same thing here. When people come in and they tell us what's important to them, we look at their situation and what they're trying to accomplish, then and only then can we design a program, not a product, but a program that will suit and support their desires.
And Randy, I think a lot of people, when they call 417-889-7233, that they think that they're going to get a sales pitch. But if I'm not incorrect here, Randy, nobody at Floyd Financial Group has any sort of sales training. We've never taken the course on closing because you just don't really need to do that. I think once it's laid out, people are going to just see it. Yeah.
That's true. What was the old thing way back when I was a youngster? I mean, I'm talking 1977, okay? I was working for a car dealership in Yakima, Washington. And this guy, like you said, they had a canned sales pitch. And it was just the same thing for everybody. And the guy even said, he says, Randy, the thing about this is, he said, there's about 30% of the people that cannot stand to do business the way I want to do business. He said, but I don't really care because we have the other 2/3. So, we don't really approach people like that. We want to approach everybody as important because they are. And everybody's the same. I mean, we all have our goals and the things we want. We all have our fears and our life experience that led us to the point we're at today. So I think it's important for us to sit down, get to know people, and know where they're at and what they're thinking.
Right, and don't expect a sales pitch because it's not going to happen at Floyd Financial Group. 417-889-7233. You're hearing the program today and you're thinking to yourself, boy, I don't want a sales pitch. I want someone who really listens to me and matches me with the right product or service. Well, give us a call here because we can set that up for you at no cost, no obligation whatsoever. It's just a casual conversation at 417-889-7233. We're talking about some questions that we commonly get here at Floyd Financial Group. When the markets feel uncertain, Randy, what types of investments do you tend to favor for retirees?
Well, we have to always go into any investment plan, Jeff, knowing that there's going to be good times, there's going to be bad times, there's going to be medium times. So what we try to do is really develop a diversified portfolio. We need some protection, right? Because we know that if we retire when the markets are headed up and we're in one of these periods where maybe we have 20% growth back to back, we're going to stack money and that guy's going to feel just great in retirement. However, sometimes people retire like some people did back during COVID. They came in and they said, hey, can I still retire? COVID is going on and it looks like the market's crashing. Can we still do this? And the answer is, yes, we can generally help people retire in all kinds of weather because we know this, everything is going to cycle. And, whether I've got a farmer in the room or a guy that's an investment advisor, an insurance guy, a real estate agent, all markets cycle. And so as we start to build portfolios for retirees, we have to take all those things into account and build something that is not only flexible, but is also resilient during times when markets are not always so good.
Randy, what are the most overlooked retirement risks that have nothing to do with the stock market?
Yep. So people outliving their money, that's the number one. That's what you referred to earlier that said they fear that more than death in some cases. Of course, healthcare and long-term care is another one, but probably the sleeper of all of them is not knowing how your tax situation works. And there's some mistakes that can be made there that we really want to help people avoid.
And if it's not managed properly, I understand that you can give up as much as 25 to 40% in taxes. Is that right?
For sure, that's easily doable. The other thing that's kind of problematic sometimes if people make the wrong move is we have IRMA to deal with, which basically it makes your Part B Medicare cost a whole lot more for a couple of year period if you breach a certain number there. So there's just many things. Sometimes we're going to get into capital gains situations that we can look at that are going to be over and above what you're paying for regular income tax. There's a lot of moving parts there, and really people need somebody to guide them through the process of what they're thinking. Well, here's where we are today. Maybe we got an extra house or we've got a farm. Do we plan to sell that farm? When do we plan to sell that farm? Maybe we got a house that we need to pay off or we want to pay off. We got a big 401k. Do we tap that 401k to pay off that house? What's our interest rate? All these things come into really setting up that efficient tax plan.
So it sounds like the thing that they're really overlooking with taxes has to be timing. It's when you do things. Would that be about correct?
That would be exactly correct.
People focus on how much taxes that they're paying this year, not how much they're going to be paying over 25 or 30 years. So tax is something very, very important and something certainly in a financial plan here at Floyd Financial Group. All right, Randy, final question here. Is it possible that some people are saving too much and living too little because they're just simply scared?
Yeah, I think there's a lot of that out there. And then there's just some people, too, that have gotten into, and I hate to call it a rut, but sometimes they've gotten themselves in a position to where they've just saved and saved and saved and worked and scrimped and saved to where it's who they are. And sometimes I have to say, it's okay for you to take your wife on a trip now. It's okay for you to start to spend some of this money because this is why you did it, right? I often equate it to the little furry squirrels we have running around the ground here all the time, and that is they stick nuts, up in trees, they bury them in the ground, and guess what? When winter comes, even they know to go dig them up and eat them so they don't starve, right? So
that's right.
We want to make sure that people know, and we get them to a comfort level, I guess, to where they can actually spend confidently and take some of that worry out of it for them.
Talking with Randy and Jake Floyd, Floyd Financial Group. We've been talking about some of the common questions that we hear here at Floyd Financial Group. Let me talk to listeners here real quick, Randy and Jake. If you want to be better prepared for your retirement future so that you can have a better quality of life, you're looking to have a casual conversation to help you understand your options and what it takes to minimize taxes, plan for long-term care, maybe an income plan, that I want you to call 417-889-7233 and request your meeting with Floyd Financial Group's advisors here. When I talk about advisors, it's really kind of just you and Jake, isn't it, Randy?
Oh, yeah, that's right. It's us. We're here all the time. And Jake, especially now, is here all the time.
Yeah. I think unlike some other folks, and particularly with the big firms, you talk to one person, and then when you call back, it's another person, and call a third time, it's yet a third person. But the people that you're hearing on the radio right now are the people that you're going to be talking to. So if that's the sort of service that you want, the sort of relationship that you want, call 417-889-7233 and request that casual conversation. No cost, no obligation, no judgment. Will meet you where you are. Again, it's 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Let me ask a question of our audience here. Who hates taxes? Hands up. Well, we'll be talking more about those when Show Me the Money continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpas, Randy and Jake Floyd.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and we're going to be talking about basically who hates taxes, which is all of us, because, Jeff, taxes can be very taxing.
That's right. Oh, boy, are they ever taxing when it comes to April 15th. Well, let's dive right into the big question here that you posed, and that you posed in a lot of your workshops in the past here. You often ask for a show of hands. Who hates taxes? Why do you start that way, and why is this topic so emotional for retirees?
Well, yeah, everybody, in fact, this is a common theme that we hear is well, I paid taxes my whole life. I don't think I should have to pay any in retirement, right? So
Right.
we wish that were the case. But, in many cases, people have 401ks and IRAs and things that they save money and that have never been taxed. And so at some point, the government says, hey, we've allowed you to tax defer and grow your money on our money. And so now it's time for us to take some money out of there. But taxing Social Security and taxing your investments and things sometimes seems unfair to people. And it's just one of those things people say, yeah, I pay taxes. I wish I could be done.
Right. And, we have a lot of what we call Midwestern millionaires in this part of the country, too. And these are people who've done everything right. They've packed their lunches, they paid their homes, they've worked hard for decades. So when they are hit with huge tax bills, you're right, it does feel unfair. You often say something that surprises a lot of people, Randy. The IRS already has a tax plan for you. Okay. What do you mean by that?
That's true. And the biggest thing here is people need to be cognizant of that fact that they are going to pay some taxes in retirement, most likely. And there's some people that get away with pretty low amounts, but you got to be living on pretty much a shoestring to do that. But you need to know that you can mitigate the damage. And if you got IRAs, 401ks, investment portfolios outside of retirement plans, if you've got CDs, if you've got money market accounts and all those different things, all those things are taxed in a different way. And many times, and you got Social Security, many times how we structure the income to come out of those can really save people a lot in taxes. And one of our goals here all the time is to try to keep people in one of the lowest tax brackets, which right now is the 12% tax bracket, because once we give money to Uncle Sam, we never, ever get it back.
You have said before, Randy, that taxes are on sale for right now. Explain that for our listeners.
Yeah, basically, we're really at the lowest tax brackets that we've ever seen. And of course, thank goodness for the big, beautiful bill that we have got those locked in supposedly forever, but that's only until Congress says, maybe not.
Nothing more permanent than a temporary fix here.
Exactly right. Yeah, temporary government program, right? So anyway, marginal rates have been much higher, as high as 90% for people that made a lot of money way back in the day, but even in the 80s, it was 70%. Top rate today is 37. The national debt, we got $38 trillion out there. We need to grow our economy and stop spending, and then we can pay some of that down. I don't know that Americans are ready just to pay higher taxes. So I just think that people need to be aware that they need to really look at their tax picture and let us figure out the best, most efficient way to get you your income now and looking forward. And for some people, there would be an opportunity to maybe set up a Roth IRA, do some conversion along the way. I will tell you that needs to be weighed out on each individual basis. That is not a blanket fix to reduce taxes. In fact, sometimes you will hurt yourself more than you help yourself. But planning today and looking forward is what really matters.
Right. And as we've said, if you do not have a plan, the IRS does have a plan for you. And it sort of feels like when you do tax planning, Randy, do you feel like that you're putting the client back in control of their taxes, something that they can really count on?
I think they need to be aware of where the lines are, right? I had a lady in my office yesterday, and we were talking about this very thing. And I said, we got to really watch that we bump our head at the top of that bracket, but we don't want to go into that next bracket in the 22%. And she said, oh, yes, I'm very aware of where that is, and I make sure I never cross that line. Now, this lady, in all fairness, was an accountant for a fireworks company for a number of years. So
She gets a blast out of her job, doesn't she?
yeah, truly, yeah.
You use a simple analogy sometimes, Randy, and that is the bucket, the 3-bucket approach. Can you walk us through that a little bit?
Yeah, basically, the 3-bucket approach just talks about you have 3 buckets of money out there. That the taxable bucket that's always out there, if you got checking accounts, savings accounts, brokerage accounts, 1099s, every year there are some things that are tax deferred, like IRAs, 401ks. If we have certain bond funds that we can buy, you're going to pay the taxes down the road on those. Then you have the tax-free bucket, which basically is the Roth I had talked about earlier. And a lot of people don't realize today there are Roth 401ks. So depending on what your situation is, I would say this: if you're a very high earner right now, a Roth 401k might not make sense for you. You may do better taking the tax break. However, that's not always the case. We need to look at each individual situation and look at where we are today and where we think we may be tomorrow in our retirement. Is it 5 years down the road, 10 years down the road? See what kind of income we're planning to spend, because some people are going to have enough income and they don't owe anything once they get to retirement. They're not planning to spend $500,000 a year. They're planning to spend $100,000 a year, and they want to grow their wealth and pass it to the next generation and their grandkids. So all of their goals and desires and dreams fold into this overall master plan of which of these three buckets we need the most money in.
So the three buckets, basically the taxable bucket, then we've got the tax-deferred bucket, and then finally the tax-free bucket. Talking with Randy Floyd here, Floyd Financial Group, about our favorite topic here, that is going to be taxes. So what are the ways that people can move money from that tax-deferred bucket to the tax-free bucket? You had mentioned the Roth. I've heard of the backdoor Roth. What is the backdoor Roth?
Well, there's limits on who can actually, based on income, who can actually put money into a Roth in a given year. So the backdoor Roth, let me say this, we need to have individual consultation on that to make sure that it even makes sense for people in a lot of cases. But basically, the backdoor Roth is a way for us to legally, within IRS guidelines, get around the income limitations and convert taxable dollars to non-taxable dollars. Now, make no mistake, you don't skirt the tax system. When you convert, you are going to pay taxes. And so the tax-free bucket that we talked about here is actually an after-tax bucket with growth that is tax-free. So you've paid taxes on what was tax-deferred. Make no mistake, there is no way around that unless you don't take the tax break up front. You set up the Roth today, knowing that you're paying taxes on all the money that went in there. And we also have to remember that the Roth conversion takes basically 5 years and 59 and a half for us to draw the earnings out tax-free.
So, Randy, for our listeners hearing us in the cars today, maybe they're at home, working in the garage, something like that, they're nodding along. What does tax-smart planning actually look like for the average person?
Yeah, so everybody's situation is different, but let's just talk about maybe a typical scenario where people have cash money in the bank and in CDs. They have maybe a brokerage account, something outside of a retirement account, and then they have their retirement accounts. And so when we look at brokerage accounts, we have, yes, growth based on stock price, but we also have dividend income. So based on where you fall with your dividend income and what tax bracket you're going to be in, you may or may not pay any taxes on those dividend payments. The other thing is that will also affect Social Security. If you don't get taxed on that, it may keep you in a lower Social Security tax bracket. And then also, if you take money from your IRA or your 401k, it may allow you to stay in that lower bracket and pay a lower overall marginal tax. So it's just one of those things that everybody's different. We have to really look at how does that piece together, and how does it piece together with the amount of income they want to have in retirement.
Okay, Randy, final question here. What should listeners do if they want to find out how much taxes they're actually going to owe in retirement? Most people have never really seen that number.
Right. Well, they should give us a call and come in and sit down and talk with us, because we can help them to understand exactly how those pieces all go together. And then again, depending on what their long-term goals are, we can talk about those as well and really develop a strategy that makes sense, whether that may be to buy a lake house in the future or now, or sell a lake house that they've had, or sell a farm. All those things come into smart tax planning.
Talking with Randy Floyd of Floyd Financial Group, we're talking about tax minimization and tax planning. And again, if you've got questions, 417-889-7233. So, Randy, what actually does a retirement tax analysis really look like? What are some of the things that it's going to show you?
Yeah, so it's going to show people how much you're going to pay, how much tax you're going to pay on Social Security, your overall tax bracket, and we can also look at it based on account, whether it's from your savings account, your CDs, your brokerage account, your IRA, 401k, from your maybe some of your government investments into treasuries and municipal bonds, those sort of things. We can show you how each of those affects your tax bracket and how much tax you may or may not pay on all of your different investments as those flow into your retirement income.
Great information, Randy. Let me talk to our listeners here for just a moment. If you want to be better prepared for the taxes that you pay so that you've got a better quality of life, we invite you to give us a call here at Floyd Financial Group at 417-889-7233. Request your retirement review, which will include taking a look at your tax situation. We'll find a way to try to minimize those for you. Again, it's not going to cost you a dime. 417-889-7233. No cost, no obligation, certainly no judgment. You can also find out more about us online at FloydFinancialGroup.com. Time for a break, Randy and Jake. When we come back, we'll be talking about protecting a spouse, the most overlooked risk in retirement planning, when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about one of the most overlooked retirement planning aspects, and that is protecting your wife, your husband, or your spouse.
And it's one of the biggest, most overlooked financial risks out there, Randy. We often talk about market risk and tax risk and even inflation risk, but you say protecting a spouse is actually one of the biggest blind spots. Why is that?
Well, you know, many times we're married, like Lisa and I are coming up on, we will be married 44 years in January.
Gosh.
Don't look at me.
It's just,
He looked over at Jake.
He's like, busted.
It's like, why are you looking at me?
Now everybody knows he had to think about it just a little bit. It's okay.
Yeah.
Okay, how to make that calculus. See, Jake's 41. Okay, let's make it 44. I got you.
So anyway, it's one of those things where you just kind of go through life and everything is just normal and everything plays out. And it's just not something sometimes that people think about. They think, okay, we get to retirement. You're going to have your Social Security. I'm going to have my Social Security. We got the 401k. We got the investments. But many times we don't really realize what happens when one spouse is no longer there. What does it change cost-wise? What does it change income-wise? And tax brackets change. I mean, you basically have lost half your deductions and you'll probably climb up into a larger tax bracket than you were in. And sometimes people have pension plans, and many times we see people kind of made, well, I won't call it a mistake, but it was a choice that they get to make. You know, does my pension survive me and go to my spouse 100%, 50%, 75%? Not at all. Sometimes they haven't really factored in what happens when somebody does pass away. So there's just a whole lot of things to be considered, and it's something that most people really don't think about until, something happens and it may be imminent, or something like, wow, this could happen.
Right, and most people do not realize what could go awry, and statistically, women live longer than men anyway, and one of the biggest shocks is that you do lose one Social Security check, the smaller of the two, and as you said, if there's a pension, it may not have a survivor's benefit, it may drop to 50%, or it may drop down to zero. Some annuities may stop entirely, and the household moves into a single filer tax bracket, which is going to be higher. So that is why we call this the silent retirement threat. And it's not just finances, right? The surviving spouse all of a sudden has to take care of absolutely everything, don't they?
Right. Can't tell you the number of times where I would have somebody come in and say, well, I've never done this before. He took care of all of this, or she took care of all of this. I don't know where we are. What's going on? So we have to kind of help them sit down and figure that out and put it together. The other thing I would say that a lot of people don't plan for is, do they have a power of attorney if somebody becomes ill even, right? And they have to take care of this. Do they have a power of attorney with their son or their daughter that says, you know what, my husband always did this, my wife always did this, so hey, Jake, come help me with this. And you have to have a power of attorney on file to make that easy. Now, you can get them on the accounts and change all that after the fact, but I would tell you that anybody that's over 18 that hears this needs to have a power of attorney, because you never know when something will happen where you need to have somebody act on your behalf. And if you don't do that, you have to go to court to get permission.
All right, so power of attorney, very, very important. If someone wants a power of attorney, how simple is it to get it?
Pretty simple. If you so desire, you can call the Floyd Law Group and they can sit you down and help you get one of those done.
So there's a durable power of attorney. There are other powers too. What about bank accounts? I mean, is there something called a POD and that sort of thing, or a TOD? What are those all about?
Yeah, the PODs and TODs, that's at death for sure. But now the power of attorney at death is no longer valid. But for that remaining spouse, it might be nice to have a child to be able to help them navigate through this stuff. And of course, that power of attorney would then be on the person that is surviving, and that's how they could help out.
So, Randy, let's talk about solutions here. You said that every couple needs a spousal protection plan. What does that include?
Sure. Everybody needs to make sure that they have enough income to live on, right? So we call that income continuity, just to make sure that there's not a dramatic loss that just can't be survived, where we have to sell homes and make rash decisions right away. The second part is tax planning, knowing that we're going to fall into a larger tax bracket probably right away. It's always been said, or I've heard it over my life, two people can live nearly as cheaply as one. And in a lot of cases, that's true. There's a lot of things that just don't change. So thinking that the expenses are going to cut in half is just wrong thinking. And then last, healthcare and long-term care. When we don't have that surviving spouse at home to try to keep us out of the nursing home, we don't have that person there. We have to rethink what might happen should we need long-term care or just some help around the house.
And I've often said, too, that two people can live as cheaply as one, but I also add if one doesn't eat. So you want to consider that as well, too. So income continuity, very, very important. Tax planning, healthcare, long-term care, but also I think making the investments and accounts easy to manage. Finally, legacy and beneficiary planning, making sure that assets transfer smoothly and tax efficiently. What tools do you use, Randy, to make sure that income continues for the surviving spouse?
Yeah, so many times it's just a continuation of the investments that we have. Sometimes we can use an annuity payout system to do that. But generally, it's just continuation of the investments that we had. We may have to spend at a little higher rate than we did before. But again, it's generally something we've thought about and looked at on the front end.
So, Randy, Social Security optimization, that is something that's important too. Pension survivorship options too. If you're getting ready to take a pension, choosing the right payout, guaranteed lifetime income riders on certain annuities, but also life insurance, Randy. That is one way that you can make sure that the people that you leave behind are still able to pay the bills, right?
Absolutely, because life insurance proceeds are generally tax-free. So that's something that can really help to pay off a mortgage or just clean up maybe some debt that you have if you weren't fully retired, because sometimes people die early. We just don't know exactly when that's going to be. But yeah, it can certainly be a great benefit, especially if we had somebody that did have a pension plan that they took out the maximum, the lifetime pay just on their life. The life insurance can be set up then as a backdrop to give them some cash to reinvest to create an income for the surviving spouse.
And Randy, I want to circle back to something that we touched on earlier, and that is the single filer tax bracket. Now, that is something that most people never think about. Can you expand on that a little bit more and tell us why that is really a very big deal?
I will tell you that if you go from being married to single, that first year you're going to think about it because it's going to hurt. Yeah. And unfortunately, you would think that the tax bracket would be for a single person half of what it is for a joint filer, which is technically true, but if you're widowed, you're going to have more income likely than half of what the income was. So a lot of cases you get just smashed on taxes after losing a spouse. And a lot of people are just not ready for that. They're in the middle of grieving. They're in the middle of trying to figure out their life. And then tax season comes around and says, oh, by the way, you owe. Again, they will get to file jointly that year that the spouse passes, right? But the next year is the one that'll come back and clobber you right as they're about to get over things. Oh, by the way, you owe several thousand in taxes just for icing on the cake. So that's definitely a big one.
So for people listening to the program right now, Randy and Jake, and they're saying to themselves, we don't have anything in place, what should the first step be?
So the first step is just to give us a call and let's sit down and get to know one another and then find out what's important to you and really sit down and develop a plan. So how do we get you retired? Number one, if you're not already, but if you are, looking at this spousal risk. And one thing that we should do is we should make sure that our spouse is going to be okay in our absence, right? I mean, I just think that's something that us guys should do just because, like you said, most times we check out a little bit early. We should not leave them just in the lurch there. So number one, let's look at what happens if one spouse dies to income. What happens to taxes? Survivorship benefits, are there any on pensions, that sort of thing? And if so, how does that apply and what's that going to do to the income loss that we're going to have? And, like I alluded to earlier, does the surviving spouse know where everything is? Do they know how to manage what's going on there? let's identify those blind spots and let's get a power of attorney in place at least, and let's get somebody that can help, have somebody in the wings that can help in the event that this happens. So they're not just trying to, I don't know what to do, and trying to figure it out. Because let me tell you what happens sometimes just by accident. We had a couple in here that basically they had lost the last of their parents, and their parents, trying to do the right thing, had transferred an asset before they passed away. Well, when you pass a piece of land or a property or something like that into a child's name before they pass away, you get the cost basis of the parent when that passes to the next generation, which is really problematic because generally speaking, we get a step up in basis to the current market value. So we see this a lot with family farms around here. If we got a family farm that somebody paid $100,000 for 25 years ago, it may be worth, $1 million or more, maybe $2 million today. If we transfer that into their names while we're alive, and here's the thing, these are well-meaning people. They're not trying to do anything wrong. They're trying to give their kids a leg up, right? And so sometimes during the stress of losing a loved one, people will make decisions that don't make good sense. And so you need to be sure. The hard thing is we don't know what it is we don't know, right? So that's why we need to make sure we have a professional in our corner that can help us with all these different things we've talked about.
Talking with Randy and Jake at Floyd Financial Group, and we've been talking about a lot of things in the program today. If you missed any part of our program, remember we're also a podcast. Go to wherever you get your podcast, search for Show Me the Money with Randy and Jake. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. We certainly do appreciate you joining us here each and every week. If you have questions about anything that we have talked about today, 417-889-7233 is our telephone number. If you're looking for a holistic approach to your retirement plan to help you really understand what it takes to be successful in retirement and confident, then again, I want you to call 417-889-7233 and request your no-cost, no-obligation, no-judgment retirement review. And again, it's not going to cost you a dime. As I said, it could be the most important call that you'll make all year. And 2025, just less than 30 days left on that. So once again, it's 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. Well, Randy and Jake, we're out of time for this week. I want to thank you for your time, but most importantly, I want to thank our great listeners for joining us here, the last bastion of Saturday, Springfield, Missouri. So for Randy and Jake, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSTF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.